I think it'd be pretty helpful to talk through a simple management agreement structure because speaking to some owners, investors in the market who are kind of new to this now, because they're seeing the value of having a flex or a co-working operator within their small asset, trying to figure out what a management agreement deal structure looks like and what are the negotiation points. So I'll kind of go through, a few of the key things maybe, and if you'd like to talk about it more, feel free to reach out. So first and foremost, if you start with a co-working deal and you're looking to partner with someone, first question is who pays for the capex, right? Generally speaking, if it's a partnership style agreement and you want some form of say in the way that the fit out looks because you want to tailor it to your building, the landlord's on the hook for the capital. Okay, and the best way to think about it is even though it's a management agreement, almost look at that capex as the incentive you would have given to a traditional tenant if you were just leasing that floor or two to some form of company. In this current market within Australia and Sydney and Melbourne, you're looking at 30-40%, pretty aggressive. And as long as the return you get from that co-working or flex space from that operator, and it's case by case, rivals a market rent equivalent before you discount that incentive hit, you should be coming out on top. And depending on the size of it, you might get a 2-3 year payback. But again, it's case by case. So capital, owners on the hook for under a traditional management agreement. Then the next thing is probably, your costs, your operating costs and everything. It's a negotiation point that you can look into, who's going to pay for that. Generally speaking, under a pure management agreement, it comes out of the income generated from the co-working or the flex space, meaning the revenue, sorry. And it's almost like a waterfall payment structure, which I can get into. However, some operators in the market are happy to be on the hook for that operating cost. By that I mean the staff, the technology, the systems, all that kind of stuff. That quantum, in case for whatever reason a meteor hits the world and it's empty, they'll be paying for that. When you get into how do you split, I guess, the revenue that comes in from an operator fee perspective, so whoever you're partnering with, there's two real ways to look at it. The first is a revenue share style model, and these go hand in hand with profit share models. Again, case by case, depending on how large the site is, but we generally see anywhere 4 to 8% of revenue, and that's the flex revenue, so most of the money comes from the private office desks and the meeting room spaces and that kind of stuff. So take a percentage of that. That percentage will go up the smaller the space is, because when you think about it, that small pool of revenue that comes in will change depending on how commercially orientated that site is, therefore the higher percentage, and lower percentages if you're dealing with a pretty big space, 2,000 to 3,000 square meters plus, because there's a lot of revenue being generated. So that's a way to for the operator to put skin in the game if they're not putting in capital, because their income is attached to how much money the space makes. And certain operators will also ask for a base guarantee, a small fee that's guaranteed to them, because at the end of the day, they're putting in a lot of work, especially within that first year, that first 12 months, to ramp up the space. So while the space is only 20-30% occupied day one, till it kind of hits that 85% occupancy and you're maximizing your revenue potential, it just kind of protects their their income needs as an operator themselves. Then on top of the revenue, you can look at profit share. So profit share, this percentage, it really depends on how you define profit. And the simplest way to look at that is, is profit just revenue minus costs? In that case, the profit share percentage to that operator should be very small. We're talking like 3 to 5% in some cases, because that profit pool is quite large. However, what's more common is you negotiate with that operator some form of base rental equivalent requirement for you as the owner. So, let's say your gross rent is $800, right? You negotiate, hey, we want 400 as a base rental equivalent to us as the owner, plus or minus outgoings, depending on what you want to do with that deal. So then after that money flows in and they kind of hit that target, that hurdle, only then profit is calculated. So your profit pool is smaller, which means that your profit share percentage will not look like 3-4%, but suddenly it could be a 50-50 split, or it could be, 60-40 in the favor of the owner, or vice versa. Because now that you've got these two levers, the revenue and the profit, you could push onto the operator, hey, we want you to take less revenue percentage, but we'll increase your profit share percentage to try and put some more risk on them if that's what you want. That being said, it is case by case because some owners would rather, put less risk on the operator, pay them more actually upfront as a guaranteed management fee structure because they want more control over the space and they actually want to maximize their profits for that particular location. When you're dealing with management agreements, the reason why I could go in this direction of more levers, more risk on you as an owner is because frankly, you've decided you don't want to put in a traditional operation within the building. You want to kind of like put in some risk and do something yourself, which is why you want to see more of that upside, right? And frankly, even though you're creating a brand from scratch, which can be challenging if you do it on your own, which is why it's always good to partner with a white label operator to do that. As long as you market it correctly, you do your pre-marketing, you make sure that you've got 3 to 6 months before you launch to get that initial occupancy, that 30% occupancy-ish, so that it covers all of those operating costs day one and make you some money. I actually think the strongest point is the building and the address. It's not necessarily the brand that you throw in there. Some brands in the market have very strong ones, so of course it attracts interest. But at the end of the day, the decision making isn't necessarily always going to come down to the brand. It's going to come down to address, building, what's the experience you're putting in there, right? So don't be too afraid if you're going down that white label route, especially if you're following the trend of doing smaller flex sites and not these massive ones, right? If you're doing like a 1,200 square meter flex operation, I think as long as you've got a good operator who fills it the right way, markets it the right way, works with agents, works with third-party listing platforms, has a gun center manager on site, has headquartered sales support, blah, 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 has budget within their flex OPEX for digital marketing and advertising, you'll be fine, right, for those small ones. I wouldn't stress over that. What else is there? I'm sure there's more because I'm just kind of riffing off the top of my head. But if you want to reach out, I'm more than happy to walk you through a detailed deal structure. I can talk to you what our deal structure looks like as a JLL Flex operator. We tend to take a little less risk because at the end of the day, we're part of the JLL machine. But our partners are happy with that because they know it comes with governance, safety, because we're a Fortune 200 company, the moral obligation that we'll never leave you high and dry, and we'll work with you because we probably and very likely do more business with you via leasing, property management, project delivery services, all that kind of stuff. So we're almost like a service ad, right? The Flex P&L, even though it's great for my team, is a drop in the ocean compared to the business you do with everyone else, which means if anything ever kind of goes a little sour with us, which it won't, or something you're not happy with, we'll do our best to fix it and we'll optimize it, or I'll get a smack on the head from our Australian CEO, very likely, right? When you think about it that way, that's kind of how we're probably one of the safer partners, and we've done a plethora of sites within the region that I'm more than happy to talk to you about. The other thing I'll add is some operators are doing a base rental guarantee. Some of the private operators that are willing to look at that, and we're not talking about leases right now, which are quite rare unless it's part of an operator's strategy to really underpin some of the prime assets in the market. What I would say is, even though it looks super attractive to kind of guarantee that rent, like, let's be realistic, it means that you're probably going to lose a bunch of control. So you're almost doing a deal as if you were to put a normal brand in your building, but unfortunately you're being pushed to management agreement when it should be a traditional lease if you look backwards 5-6 years ago, even 3-4 years ago. And then you're kind of meeting in the middle by doing this quasi-hybrid lease management agreement structure, which is totally fine if that's the best deal that you can get and all you want to do is throw in a co-working operator in there. But if you want something tailored, if you want something that you want to control, just realize it's almost like a Richter scale and spectrum. The less risk you want, the less control you get. And I frankly think the smaller sites, more risk right now is what you probably need as an owner, especially if it's a small percentage of your total NLA for your asset, because you got to do something. And if it helps you let up the rest of your building, you should really look at the Flex P&L not in isolation for that single floor or two. Look at it as a holistic, reduction of downtime by this many months per floor. We've actually signed a bunch of these anchor tenants because they've been asking for Flex. Whether they use it or not, frankly, who cares? If it gives them the comfort to sign that long-term lease, just make sure the operator who's doing that small space within your building knows how to commercialize it without tenant usage, right? So hopefully that was helpful. And And my email is going to be at the end of this video, and drop me a comment or a direct message if you want to talk more. Speak to you again soon.